Welcome back, everyone. Let's take a look at how Treasuries are headed off the back of this morning's jobs report. Current yields, another data point in painting a bigger picture of where the economy is headed and showing where the Fed is headed with quantitative tightening here. Joining us now with more, we've got Simeon Hyman, ProShares global investment strategist. Simeon, always a pleasure to speak with you and get some of how you are perceiving the markets and what they're reacting to here. When we think back on what August was here, particularly you mentioned a note that there were some classic rising rate and inflation favorites like energy and financials. Does that persist going into September?
I think it may very well. And it's interesting that you said quantitative tightening just a second ago. Guess who didn't say quantitative tightening? Chair Powell didn't mention it once last Friday, which was interesting because yesterday, actually, the first day of September, the pace of the shrinking of the balance sheet actually doubled. So if you put that together with stickiness on the inflation side, and I'll point to today's employment report, we still had over 5% year-over-year wage increases. That's a little bit of the stickiness of the wage price thing. So you put those two things together, and I think the answer is yes, there's still impetus for some lingering inflation and more rising rates across the curve, and that does play to some of the classic sectors like financials, like energy and materials that are likely to outperform.
Simeon, we're seeing the markets come off the highs of the session after this jobs report. Stepping back, is this report bullish or bearish for stocks in the short term?
This one was kind of neutral. So I mentioned the lingering wage issue that still runs over 5% year over year. But everybody likes the fact that participation ticked up. So even though the job growth number was pretty big, you still had a slight tick up in unemployment. It all goes to, okay, we still have a chance at a softish landing. So I think it's going to play out over the next few months. But I've mentioned a wild card that may help, at least domestically, in terms of the possibility of soft landing. And that is almost a little small version of kind of a post-World War II boost. And what I mean by that is the rest of the world, lots of it is still kind of messed up. We know what's going on in Europe. Very sadly, we hope for, an end to the war in Ukraine. But that and the energy price and gas issues in Europe are a major obstacle for economic growth. China's still not fully reopened, and that means that we have an opportunity domestically to fill a little bit of that global gap for a little while, and that may help soften the landing in the U.S. a little bit.
Simeon, when you say this jobs report is neutral to markets, does that mean in September markets will trade in a band of up 5% and down 5%?
Well, we're going to be in almost a dearth of information zone because I think yes, we'll get CPI. We get that every month. But I think the next big indicator is going to be those Q3 earnings. That's really the next big piece of information because it's very interesting. What we've seen in the last 2 quarters is exactly what folks have been concerned about. Now, yes, earnings growth was decent in the last 2 quarters, but margins were shrinking for the S&P 500. If that continues, that's going to be a concern. It's one of the reasons why we've been looking to places in the market where some pricing power has persisted. As an example, we often talk on your show about the S&P 500 dividend aristocrats. We have the ETF and OBL Noble. It's the consistent dividend growers. And over time, that's a great inflation hedge because they grow their dividends. But if you look at last year, what's been supporting significant outperformance, it's been widening margins. So if you can find the aristocrats have widened margins in the last 2 quarters, if you can find pockets of pricing power, that's going to be very valuable. And I think we may be a little sideways market-wise until we see some of those Q3 earnings start to come in. And we're still 6 or 8 weeks from the beginning of the season.
Okay, so even if the report itself was neutral, is it market neutralizing in terms of the move that we've been tracking since last Friday, since the Fed's and Fed Chair Jerome Powell's 8-minute speech at Jackson Hole, which triggered this most recent sell-off?
I think it's going to be more about quantitative tightening, and I was so glad you said it because that's what has the greatest chance of moving the dial be again in the longer end of the curve where the suppression of yields is being removed, that's where the impetus for rising rates in the 5s and the 10s can come from in the near term. So yes, I think that employment report was kind of neutral with regards to the bond market, but the doubling of the shrinking of the balance sheet that started yesterday is far from a neutral impact.
Simeon Hyman, ProShares Global Investment Strategist. Always good to see you. Have a great weekend.
Thank you.